Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 4th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on. A little bit of economic data across the pond. You know, they have a lot of service PMI numbers coming out, but it's not their flash PMI numbers. So I'm going to kind of skip over those just because they're not one of the most widely looked at, other than in Great Britain, service PMI came in at 54.2, expected to be 54.1. And then here in the United States, we've got challenger job cuts coming in at negative 3.6%. Didn't have an expectation on that, but much better than last month's number of 30%. So that was a pretty big number. ADP non-farm payroll, which isn't the main one. Tomorrow's non-farm payroll number is going to be the one that is more widely looked at, but it is an indication. It's getting a little bit better. When it first came out, it was really quite a big difference in some of those numbers. But the ADP non-farm payroll change came in at 250,000 hires, expected to be 191,000. So much better than expected on that front. So that would lead one to believe that the economic data for tomorrow in the non-farm payroll number for unemployment should be pretty good. And then here in the United States, again, we got unemployment claims came in at 250,000, higher than the expected 241,000. So claims going higher, not that great for the economy. It shows, you know, people are looking for jobs. Although then we have the non-farm payroll employment change increasing more dramatically than the unemployment claims. So that's, you know, a good thing, I guess. It's a little bit better anyway. Then we had our final services PMI coming in at 53.7, expected to be 52.1. Natural gas storages coming in at 206 billion cubic feet drawdown, slightly less than the expected negative 221 billion cubic feet in storages. So a lot of that having to do with some of the real cold weather we've had across the United States. As a matter of fact, earlier on in the week, I think there was a thing at like 5 o'clock in the morning. The national average for temperatures was negative 11 degrees Fahrenheit. So that means, you know, everywhere from North Dakota all the way down to basically here in Arizona, the temperatures on average across the United States were negative 11 degrees. So that was pretty big. So I'm sure a lot of natural gas being used there. So we could even see that number being revised next month. And then crude oil inventories, we had a drawdown of 7.4 million barrels, expected to be a drawdown of 5.2 million barrels. Now remember, we've been seeing these massive drawdowns in crude oil inventories. Production starting to increase a little bit with the oil up in the 60s, anything above 50. These guys in the fracking operations are able to start ramping it up. We are seeing that. We are also seeing some, you got to read into the lines here, because what we're seeing is that the crude oil inventories are going down due to refining of those products. So those refined products, being gas and distillates, are actually really going through the roof on the inventories there. So for instance, if we look at gasoline inventories, even as we've had like the holiday season, we saw that gasoline stockpiles climbed 4.8 million barrels for the week, and distillate stockpiles jumped to 8.9 million barrels. So what they're doing is they're taking it from one bucket and putting it into another bucket in a sense, and everybody only looks at the front bucket. Or, you know, if you had a bunch of coffee and you took that 2 pounds of coffee, ground it all down and made a bunch of coffee. Well, yeah, you're low on coffee beans, right? But you got stockpiles of coffee that nobody's drinking. So that being said, we're seeing a lot of drawdown, but it's because they're just stockpiling it in a different form, and it's not a headline number that people are looking at. So that is, in my eyes, more bearish for oil. If people are not using the distilled products or the refined products, then what good is it to draw down on the oil, right? If nobody's using the finer products there. So that being said, we do have oil moving a little bit higher, only by a couple of cents. It did test the trend line, my trend line there, the trend channel, the upper band there, and has since kind of come off. We could start seeing oil start making a bit of a turn to the downside, taking some profits here, I think. All right, so then on to gold futures. They're moving higher as well by $2.30 up against that 78 Fibonacci level. That acted as resistance yesterday. I don't expect any different today. Was actually looking like a confirmation of a bit of a top that I talked about yesterday, but not confirmed today anymore. But after this big run, I think that we're going to see gold kind of start to make a bit of a turn. And then we have the Bitcoin futures up, you know, a few hundred points, 200 some odd dollars. But below that 1500 level, you know, right there, 1500 is where the most time and volume has been spent for this contract. So that is where the market finds value, is right there at around 1500 right now. On to the bonds. They're off just a little bit today. I'm surprised that yesterday they even had a chance to rally at all with the markets up as they were. Everybody talking equities going higher. Today giving a little bit back by about 6 points. And then if we take a look at the VIX is moving, it looks a little bit higher now this morning when the equities were really rallying. It looked like we were maybe even going to go down and test this 8.5 level in the VIX, but it's starting to come back just a little bit. We haven't given up much of the gains. As a matter of fact, I tweeted something out earlier today that, hey, I think I saw the SPOO's downtick, because it was like an unabated rally since the open. But the Dow Jones Industrial Average up 154 points. Everybody pulling out their 2,500 or 25,000 Dow hats. You know, can we stop that, please? Every arbitrary number that we can think of for the Dow Jones, people are having hats embroidered for. Anyway, on to the the Nasdaq also making a new all-time historical high intraday, up 12 points. But I just threw in this trend channel today, just kind of lined it up here. I think that that's a pretty good trend channel for this. And we are very close to the upper band of that, so we could start seeing a little bit of weakness, especially the last couple of days since the new year. People just buying into tech unabated, so that's really causing the Nasdaq to move higher right now. And the E-mini S&Ps catching up. This is what I was talking about, straight green bar it looks like. And then if we take a look at the more of a breakdown of the E-mini S&Ps, this is the overnight session. Usually when we see the overnight session get a little bit long, they kind of slam those longs out heading into the day, but that did not happen. As soon as the market opened, you can see we just screamed higher. And this is about when I was tweeting out that I think I saw a downtick, which did cause a little bit of negative, not my tweet necessarily, but that's when we saw some profit taking going on. But now we're starting to see that rebound a little bit. So this is a solid number because it is intraday 27.29, a new all-time high for the E-mini S&Ps. Oh, and then somehow I lost all my charts on the things that I was going to look at. All right, so then the things that I've done with UPS, I added this in both my IRA and in my margin account. And in my IRA, I made it a really wide call spread because you can't have naked calls in an IRA, which is bizarre to me. But you can make it make it really wide and create a synthetic type of scenario with a short call in a sense. Basically what I do is I go out and buy the first call I can get for a nickel. And in that, I went in there and sold the January 132 calls and then bought the 140 calls. And I did that for 42 cents. I actually thought I was going to get a little bit better pricing on the long calls. As a matter of fact, it was one of those few times that I actually put the order in and boom, it got hit unexpectedly, immediately, which I hate. I like to do the cancel replace. I like to go a little bit higher than I think I can get it and then kind of move it down. Anytime I put an order in right off the bat and it gets hit, I'm not super happy because I feel like I left some money on the table and didn't allow it to work long enough to get that better pricing. But it is what it is. I sold those for 42 cents. I expect that it was looking a little bit better earlier today when I was testing this Fibonacci and coming back down. I did an extension on this Fibonacci. It's a little bit different than what we had before, but I wanted to settle below that for sure because it was looking a little toppy for that. And then in my other margin account, or in my margin account, I should say, I just went in there and sold the January 132 calls for 48 cents. So looking for a bit of a pullback. Obviously, we got super high implied volatility, 17 days to expiration. I didn't want to get in the month that has the earnings. I wanted to get in here, and with this big, huge rally, that caused volatility to go up. And would expect if we kind of get a little bit of a roll over here, maybe some profit taking going on, volatility will come out, get my directional assumption right, and I would be very happy with that. But 3 days of massive rallies, I think there's got to be a little bit of give going on here, some profit taking. All right, and then finally, with the last trade that I actually took off was in IBM, and in IBM I had on the January 140 calls in there. And I originally sold those for 38 cents, bought them back today for a nickel. Got the big rally yesterday, was squeezing it a little bit more. Today with the big bump higher, was able to get out for a dime on that one. So better than 50% of my max profit there. That's all I got for you guys today. Tomorrow we're going to be doing a webinar on a collar. That's going to be really great because if you're buying puts to protect some of these gains that we're seeing and you're just worried about a correction, so you're buying some puts, that increases what you paid for that underlying. So I'm going to show you a way to set this up to where you aren't actually increasing your cost basis on any of these stocks. All right, so go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.